Now that we understand the basics of market structure and trend, breaks of structure, and complex pullbacks, it's time to begin mapping out market structure formally. By officially mapping out market structure, we can keep track of the structural ranges and monitor these trends. This ensures that we're never caught on the wrong side of the market, as the direction is always clearly laid out and referenced. Mapping out market structure can be a bit subjective. This really depends on how you map out your breaks of structure and your pullbacks are interpreted. The best way to reduce discretion in mapping out market structure is to set rules that make it easy and systematic to map the structure and really have clarity in the direction of the market. So let's move into the rules for mapping market structure and the breaks of structure. Mapping the highs and lows should only be done using swing candle formations to highlight the relevant market swing points. These market swing points show that the market is exhausting and is likely to pull back. These points provide a consistent approach to looking at swing points. As we discussed previously, a break of structure is only valid when a candle breaks and closes above a higher low. A wick of a higher low is not considered a valid break of structure, and until that market breaks and closes above or below the structure, the range is intact. We can take confirming breaks of structure one step further by implementing the hard close candle as an additional requirement. This provides even further confirmation that price on lower time frames is breaking and closing past the structural levels. These rules will help make sure that the highs and lows used for mapping market structure swing points that form the market structure we use are using the same rules, and that structure breaks are only counted as valid if they can be shown to be true. So now that we have some rules for mapping out market structure and the breaks of structure, we need to identify and map our higher highs and higher lows. Now it's important to map the swing point of a higher low in a bull trend or a lower high in a bear trend, which are counter trend based pullback swing points, to make sure that the structural ranges are being used and followed correctly. The lowest low found in a pullback or in a bullish structural range can be used to find and map out a higher low in a bullish trend. For a bearish trend, the highest high in the pullback or in a bearish structural range is used to find and map the lower high. Using the extremes of the pullbacks makes the invalidation points much more conservative in nature, as price will ebb and flow within structural ranges for a variety of reasons. Having this flexibility in price and these rules will make it less likely that you'll be prone to fake outs in the market. So if we look at this bullish example and put everything that we just spoke about together, we can see that, conceptually, we're in a bullish market. We're seeing a higher high forming in the market. We start to see that candle swing formation, denoting that we are starting to create that apex or that high. Price begins to enter a pullback phase, as we can see that counter trend movement. We get another candle swing formation low, where we have this low is lower than this low and lower than this low. Price then begins to move back to the upside. And what we can see is we don't actually break and close above the previous high. Instead, we just wick it and we start to move back down in. So this would not be considered a break of structure, but instead more or less a fake out of structure. And as we can see, price moves back down in and then continues to move back to the upside. We break and close above the previous swing high, and we confirm that we are truly breaking structure to the upside by seeing a hard close candle formation, as the open of this candle and the close of this candle is above the previous high. Now, when we're looking at how do we map our market structure, our structural ranges, we know that the previous high is this swing point, but how do we find the previous or the swing low of our new structural range? Because we know that as the market is ebbing and flowing, we start to create our higher low, and as price breaks, we're able to use that higher low. But in this case, we have two lows to use from. And as we discussed when we were going through this, is that we want to use the lowest low found in that pullback. So although this is the most recent low that broke this pullback, this would not be our valid swing structural higher low point. We'd want to use the lowest low in the range to create our market structure points. This gives us that flexibility that price can pull all the way back down in here, and as long as we don't break below this previous low, this would be our invalidation low of our bullish structural range. That price would then continue moving to the upside and nothing would change. Now, if we take this one step further or flip what we said for a bearish market. We can see that price is moving to the downside. We're in a bearish trend. We create a swing low in the market as this low is lower than this low and this low. This could signify the start of our pullback phase after creating a lower low in the market. And as we can see, price creates a pullback. We create a market swing point where this high is higher than this high and this high. Market then continues moving to the downside. We break the previous low with a wick, but we do not close below. So we do not signify or can represent a break of structure in the market. And price then continues moving to the upside. And if we're looking at structural range, we're trading within this conceptually. So as long as this high does not break, we're still in a valid bearish market. And as we can see, price moves to the upside. We create another swing high candle formation. This high is higher than this high and higher than this high. And as we can see, the market continues to move to the downside and we break and close below the previous low. The next candle is bullish, but we have not hard closed below the previous low. It is not until this bearish candle closes that we can confirm that the market has indeed hard closed below this previous low, as the open and the close of this bearish candle has signified the hard close and the break of structure. Now, if we're looking at how do we map our previous high or our lower high for our market structure, so if we're looking at market structure, how do we map out our structural ranges? How do we map out these previous high points? We would look for the highest high in the pullback or in the bearish structural range that we can use. So if we look at this and we look for our highest high, we would use this point. So as we're moving, this would be our invalidation point high, that as long as price doesn't break above, we're still in a bearish trend. And that's as simple as we can keep it when we're mapping out our market structure, when we're looking for pullbacks, we're putting rules to everything. The key with all of this is that we can repeat it time and time again and have a repeatable process for identifying market structure, identifying pullbacks, identifying points in which that we can use to delineate higher lows, lower highs in the market that are going to create our structural ranges that we'll be continuously working with as we break down market structure further.